The construction insurance market in 2025 is in a period of transformation, driven by new carrier entrants, changing market conditions, and the evolving risk landscape. Industry observers describe the market as one of optimistic caution, a mix of opportunities and challenges as insurers and construction firms navigate new dynamics. But how are new carriers impacting construction insurance, and what does it mean for coverage availability, pricing, and competition? Let's break it down. One of the most significant areas where new carriers are making an impact is in professional liability insurance. Over the past year, multiple new insurers have entered this specialized space, bringing new capacity and making the market more competitive. Traditionally, professional liability insurance for contractors and project owners has been a challenging coverage area, but these new entrants are expanding options, creating more flexibility in pricing and coverage enhancements. However, this doesn't mean insurers are taking on more risk without caution. In fact, both new and established insurers continue to place heavy emphasis on contractual risk allocation, meaning how risk is shared in contracts between parties. New carriers are not aggressively undercutting prices, but are instead maintaining disciplined underwriting approaches, focusing on factors like project delivery methods, liability limitations, and risk transfer provisions. For construction firms and project owners, this new competition in professional liability insurance is a welcome change, offering better policy options and potentially improved pricing compared to other areas of construction insurance that are still seeing rate increases. While some parts of the market, like professional liability, are experiencing growth in capacity, other areas are seeing carrier exits. This push and pull effect means that while new carriers are entering the space, they are also replacing lost capacity rather than significantly expanding overall market availability. Take builders' risk insurance as an example. While capacity remains adequate, the reality is that some standard and E&S, excess and surplus carriers, have withdrawn from the market. The challenge for construction firms is that even with new entrants, insurers are being highly selective in how they deploy their capacity. For instance, in frame construction projects, insurers are now more cautious about underwriting multiple projects in close proximity or when the same carrier is covering multiple high-risk sites. This means that while new market participants bring options, they are not dramatically changing underwriting conservatism. Instead, they are following existing industry trends of measured risk-taking. New carriers in the construction insurance space are not simply competing on price alone. Instead, they are aligning with broader industry shifts in risk selection, pricing discipline, and policy structures. A key trend across all construction insurance lines is higher deductibles and greater risk sharing by policyholders. Builders' risk carriers, for example, are increasing deductibles to encourage more proactive risk mitigation by project owners. New entrants appear to be following this risk-sharing model, meaning that while they expand competition, they are not disrupting established underwriting best practices. Another area of focus is technology-enabled risk mitigation. Insurers are looking at new technologies to prevent losses, particularly in water damage prevention, one of the most frequent and costly claims in construction insurance. Carriers are increasingly requiring technology-based solutions to mitigate water intrusion risks, and new entrants may differentiate themselves by offering more advanced tech-driven risk controls. For construction firms, navigating new carrier entrants requires a more sophisticated insurance procurement approach. More carrier choices can be a good thing, but it also makes broker selection and market strategy even more important. A major challenge in this environment is market fragmentation. Different carriers are focusing on specialized risk niches, meaning a single insurer may not be able to offer comprehensive coverage across all lines of business. This increases the importance of working with brokers who have broad market access and deep construction expertise to help clients secure the best terms from both established and new insurers. Additionally, securing the right insurance program up front is more critical than ever. Construction firms that proactively structure their insurance placements early in the project planning phase are better positioned to secure optimal pricing and terms before markets shift further. The impact of new carriers on pricing depends on the coverage type. In professional liability, increased competition has helped stabilize rates. However, in areas like builder's risk, prices have only recently leveled off after years of significant increases, and insurers remain firm on maintaining rate adequacy. Instead of competing on lower prices, many insurers, both new and established, are differentiating themselves with policy enhancements, specialized coverages, and underwriting expertise. For example, some carriers are offering more customizable policy structures to accommodate complex construction projects rather than taking a one-size-fits-all approach. This suggests that while new market participants create competition, they are competing through specialization rather than aggressive price cuts. Looking ahead, carrier entries and exits will continue to reshape the market, but several factors will influence future participation. Climate risk. Insurers are increasingly selective about regional exposures, especially in hurricane, wildfire, and flood-prone areas. New entrants will likely need sophisticated catastrophe modeling capabilities to participate in these segments. Technology and risk mitigation. The ability to leverage real-time data, AI-driven underwriting models, and digital loss prevention tools will set apart new carriers that can offer innovative solutions. Regulatory and economic factors. If construction costs continue rising, insurers may need to further adjust pricing and policy terms to account for increased rebuilding expenses and supply chain risks. The entry of new insurers into the construction insurance space is an important development, but it's not a complete market shift. Rather, it's a measured expansion within an overall cautious environment. In professional liability, new participants are creating more competitive options, but in other segments like builder's risk, they are following disciplined underwriting trends, rather than drastically changing pricing or risk selection. For construction firms, this means that while new capacity can offer advantages, securing the right coverage at the right price still requires strong risk management strategies, comprehensive submissions, and working with brokers who understand this evolving marketplace. If you're in construction, insurance, or risk management, understanding these shifts is critical for staying ahead in a changing insurance market. If you found this helpful, don't forget to like, subscribe, and stay tuned for more insights into the evolving world of insurance. See you next time.